It's a big day for global markets. President Trump's 10-day deadline for the Strait of Hormuz is about to expire later today. And while hopes for a ceasefire are supporting risk-on sentiment, Iranian officials warn that a quick fix is unlikely, suggesting that geopolitical risks may remain elevated during the week. But it's not all about geopolitics. This week's calendar also includes US inflation data, so volatility is guaranteed. And in this video, I'm going to break down three key pairs: gold, USD against the Swiss franc, and euro dollar. So let's have a look at the charts and see what the technical signals suggest. And looking first at gold, which opened with a soft negative gap earlier today. We can see that the price has already closed this gap and is trading slightly positive after finding support near the 4,650 level, which was also a kind of key floor for downside pressures last week. The question now is whether this rebound is still valid, whether we're going to see another extension. And looking at the technical picture, we can say that downside risks are still in play. First of all, there is a bearish crossover between the 20 and 50-day moving averages, and we can see that the distance between those lines have widened. Moreover, if we look at the technical indicators down here, the RSI is still below 50, and the stochastic oscillator is set for a negative crossover. It seems that it has peaked above its 80 overbought level, so that suggests that the short-term outlook is still affected by downside risks. And now, in the event that the 4,650 floor manages to hold, we could see another test near the 20-day moving average, which blocked upside pressures last week near 4,755. But there are more obstacles overhead, the 4,835 level and the 50-day moving average near the 4,940 territory could also block any additional moves. Perhaps the 5,020 mark, which was also a previous barrier, could also block any continuation towards this critical resistance line near 5,180. We need a clear break beyond this resistance trend line over here to become confident that the broad uptrend may gain more legs. But we're still far below this territory. While on the downside, the break below the 4,650 is required in order to bring the 4,375 region back into view. Then any failure here could extend losses towards the back down to 4,150 and 4,200 territory. Well, Friday's non-farm payrolls report also had a little impact on gold. The data showed a triple-digit increase in U.S. jobs for the first time in a year. The unemployment rate eased slightly, but nevertheless, the reaction was mild, and that's because rate cut expectations were already quite low. And rate hike expectations are still not in place. So that's what actually kept gold on the sidelines. But perhaps US inflation data will be the next catalyst later this week. It could be another test for the precious metal. It will be quite interesting to see whether forecasts for higher inflation could actually bring some downsides to gold if indeed investors start to talk again about future rate hikes. And that could also bring dollar Swiss franc into under examination. The pair has staged a nice rebound since January. It has been trending to the upside and is currently capped below the 0.7990 resistance territory. It failed multiple times to break this wall, but it's still quite close to that barrier. And looking at the technical indicators down here, we don't have actually a clear the technical indicators cannot provide a clear direction. The RSI is weakening towards this 50 neutral mark. The stochastic oscillator is about to turn higher again. But what's important here is that last week we found support near the 200-day moving average. This is the first time that the price rises above this line since March last year. So if the price manages to maintain a positive momentum above 0.7940, then we could see a continuation towards the 0.8075 and perhaps towards the 0.81 and 0.8125 barrier taken from the fourth quarter last year. Moreover, what's quite striking is that the Swiss National Bank could welcome further weakness in the Swiss franc after the currency strengthened to the highest level since in 15 years. So so better than expected, actually stronger than expected US inflation data may cause volatility in this pair. Now, in the event of a bearish move, the price should cross below the 0.7915 territory and below this bullish channel, and more importantly, beneath its 50-day moving average at 0.7870 in order to re-enter this broad bearish formation over here. And in this case, we could see a steeper decline towards the 0.7770 region. Otherwise, as long as we hold within this bullish territory, the risk is probably skewed to the upside. And it's also worthy to know that the 20 and 200-day moving averages are about to set a bullish crossover. So if that's confirmed, that would be another indication that perhaps this upward move may gain more legs. And finally, looking at euro-dollar, well, there are no important events on the Eurozone calendar, and the risk-on sentiment is currently keeping the pair supported. The price managed to hold above the 1.15 level, but it's still not out of the woods. So the price is still trading below the 1.6030 or 1.6070 region, which we need to break in order to approach the 1.7070 level. And then beyond that, the next resistance could emerge near the 1.1820. And looking at the technical indicators down here, we can actually confirm a bullish bias. While the RSI is still below 50 despite testing the 50 level twice over the past couple of months. On the other hand, the stochastic oscillator is about to reverse lower, so we don't have a clear directional signal over in this chart. And what's more discouraging is that the 50 and 200-day moving averages are about to post a death cross, suggesting that this negative trend over here may extend further. So unless we break beyond 1.6030 and 1.6070, perhaps the price may retest again, may come again under pressure, especially if it fails to hold above the 20-day moving average at the 1.15 level. Failure to hold here could drive the price back to the 1.14 territory, and then another violation here could actually cause a steeper decline towards the 1.1280 region, and perhaps even deeper towards the 1.12 territory if this bearish formation over here holds. So that's everything I wanted to share with you guys. I hope you have a great trading ahead. So keep a close eye on geopolitical headlines as well as on the US inflation data later this week. Of course, we'll be back soon on Thursday for more technical updates. So bye-bye for now, and we'll be back soon.